Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. In our first segment today, we're focusing on the recent updates from the Canadian Real Estate Association, or CREA, regarding their 2025 forecast. CREA has adjusted its home sale and price growth forecasts upwards, reflecting a more optimistic outlook compared to their previous projections last fall. This change is attributed to a combination of factors, including pent-up demand over the past 2.5 years, lower borrowing costs, and the anticipated increase in spring listings. According to CREA, they expect 532,704 homes to be sold through the multiple listing service in 2025. This represents an 8.6% increase from 2024, which is a notable rise from their earlier estimate of 6.6% growth. This adjustment indicates stronger than expected market activity towards the end of 2024. Looking ahead to 2026, CREA projects a further 4.5% increase, bringing the total sales to 556,662 units. When it comes to home prices, the national average is forecasted to reach $722,221 in 2025, marking a 4.7% increase year over year. This is slightly higher than the previous forecast of a 4.4% rise. For 2026, CREA anticipates an additional 3.3% increase, pushing the average price to $746,379. It's important to note that while regions like Alberta and Saskatchewan may experience sharp price hikes due to limited supply, areas such as British Columbia and Ontario might see more moderate growth due to higher inventory levels. These projections are not just numbers. They reflect the complex dynamics at play in the Canadian real estate market. The combination of demand pressures, borrowing costs, and regional supply differences all contribute to these forecasts. It's crucial for those involved in the market, whether buying or selling, to stay informed about these trends as they navigate their real estate decisions. Today, we're diving into a topic that's been a significant barrier to home ownership for many Ontarians: development charges. These are fees imposed on developers, which are then passed on to home buyers. They cover a wide range of infrastructure costs, such as water and sewer expansions, sidewalks, and recreational facilities. However, a recent survey by the Ontario Real Estate Association, or OREA, suggests that many Ontarians are not on board with the idea that growth pays for growth. This concept implies that the costs for new housing infrastructure should be borne by those who benefit from it, namely the new homeowners. According to OREA's study, nearly half of aspiring homeowners in Ontario have either given up on the dream of owning a home or are pessimistic about their chances. This sentiment is fueled by the financial burden of development charges, which many feel unfairly targets new buyers. Ontarians seem to believe that the responsibility for funding infrastructure should lie more with the provincial government or municipalities, rather than being an additional cost for home buyers. Despite a provincial plan to build 1.5 million new homes by 2031, the target seems out of reach. Last year, only 87,900 housing starts were recorded, falling short of the 2024 goal of 125,000 new homes. To address this shortfall and make home ownership more affordable, OREA has launched a campaign advocating for the reduction of municipal development charges. Their survey shows strong public support for this initiative, with 3/4 of respondents backing a reduction in these fees. OREA President Rick Kedzior has been vocal about the need for change, emphasizing that development charges add to the already high costs of home ownership. He argues that these costs push affordability further out of reach for many Ontarians. OREA is lobbying for policy changes that could streamline home building processes and reduce costs. Some of their proposals include ending exclusionary zoning to allow for more homes to be built, and allowing water and wastewater services to be managed by municipal service corporations rather than through development charges. Another proposal from OREA focuses on intensifying housing density along transit lines. This could involve converting commercial properties to residential use, which would not only create more housing, but also potentially reduce commuting times for residents. The overarching goal of these initiatives is to break down barriers to home ownership by eliminating unnecessary costs and delays in the home building process. In summary, while development charges are intended to fund essential infrastructure, there is a growing call for a reevaluation of how these costs are distributed. OREA's push for policy reform aims to shift the financial burden away from new homeowners and towards more sustainable funding models. This could help make homeownership a more attainable goal for many Ontarians struggling with the current market conditions. In today's segment, we're looking at the latest data from the Canada Mortgage and Housing Corporation, which reveals that Canada's housing starts increased by 2% in 2024, reaching a total of 245,120 units. This represents the third highest year on record, yet it still falls significantly short of the levels needed to tackle the country's ongoing housing affordability crisis. Breaking down the numbers, we see that urban centers with populations over 10,000 saw housing starts rise to 227,697 units, up from 223,513 in the previous year. In rural areas, there were an estimated 17,423 starts. The increase was largely driven by historically high rental construction and increased activity in provinces like Alberta, Quebec, and the Atlantic regions. However, the situation was mixed across Canada's 6 largest census metropolitan areas, which collectively experienced a 3% decrease year over year. Notably, cities like Vancouver, Toronto, and Ottawa faced declines in multi-unit starts, which can be attributed to weak pre-construction condominium sales. On the flip side, Calgary, Edmonton, and Montreal saw a surge in activity, particularly in the multi-unit segment, driven by strong rental starts. This highlights the varied landscape of housing development across the nation. The monthly data for December 2024 showed a 13% decrease in the seasonally adjusted annual rate of housing starts, dropping to 231,468 units from November's 267,140. This decline suggests a potential slowdown in momentum as the year came to a close. However, the 6-month trend remained relatively stable at 242,637 units, indicating that while there were fluctuations, the overall trend was steady. According to Canada Mortgage and Housing Corporation's chief economist, Mathieu Laberge, despite the annual increase in housing starts, the supply growth still falls short of what's required to restore affordability in urban centers. Laberge pointed out that last spring, estimates suggested Canada could potentially build up to 400,000 new housing units annually, with the current resources devoted to residential construction. This underscores the need for a significant ramp-up in housing production to meet demand and address affordability issues. This data offers a clear picture of the challenges facing the Canadian housing market. While there are pockets of growth, the overall supply is not keeping pace with the demand, particularly in urban centers where affordability remains a pressing issue. Stakeholders across the sector will need to consider innovative solutions and strategies to boost housing starts and address these critical challenges. Now let's delve into the topic of what's being termed the Great Canadian Real Estate Stagnation. According to BMO Capital Markets, despite a pickup in Canadian real estate sales, prices have remained largely unchanged, and expectations for a rapid recovery may be overly optimistic. The bank suggests that this stagnation period has just begun, and those anticipating a quick rebound might find themselves disappointed. BMO points out that even with significant interest rate cuts and a normalization of buyer volumes, home prices are still moving sideways. The bank warns that prices remain too high for the market to see any substantial movement, as the lack of affordability continues to throttle demand. Despite falling interest rates, the expected boost to sales and prices has not materialized, indicating that the market's issues are more deeply rooted than just interest rates. Robert Kavcic, a senior economist at BMO, explains that while there are signs that the worst of the market correction may be behind us, the idea of a trampoline-like rebound is far-fetched. The hype surrounding falling interest rates hasn't translated into real market movement, as affordability remains a key issue. BMO highlights that although sales have seen an annual uptick, they remain historically weak. Home prices have barely budged and have even moved slightly lower over the past year. For the third consecutive year, forecasts are predicting a market recovery next year, but it's becoming increasingly difficult to differentiate between optimism and wishful thinking. A critical point raised by BMO is that despite interest rate cuts, mortgage rates haven't dropped far enough to make a significant impact. With 5-year fixed rates in the low 4% range, even additional rate cuts would only bring variable rates to similar levels, limiting the impact on affordability and, consequently, market activity. The situation in Toronto serves as a key example, with prices down 1.8% from last year, despite an increase in home sales. New listings in the region have increased by over 20% from the previous year, leaving the market balance softer than at the beginning of the year, even after the Bank of Canada's easing measures. It's important to note that while Toronto is often highlighted due to its status as the financial capital and the country's most expensive market, regional variations exist across Canada. Some markets are performing better than others, but Toronto's trends often set a benchmark for the rest of the country. According to Kavchich, if current mortgage rates persist, the market may remain stable or flat in 2025. This scenario underscores the need for a realistic outlook on the housing market, acknowledging that while interest rates play a role, they aren't the sole factor influencing market dynamics. As we wrap up today's episode, it's clear that the Canadian real estate market is facing a unique set of challenges. BMO's insights provide a sobering reminder that while some aspects of the market may show signs of recovery, the overarching issues of affordability and supply remain significant hurdles. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.